Welcome to Market Call. Jeff Olin is on our show today. He's president and CEO of Vision Capital, and he's going to take your calls, emails, and tweets on real estate stocks and real estate investment trusts, REITs. Call us toll-free, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. It's great to see you, Jeff. Thanks for coming on the show.
Thanks for having me.
The REITs have had a pretty good year in the market. You say in many cases they've narrowed the gap to their NAV. Some have even gone to a premium.
Indeed. I mean, you see that on average over the last 20 years, REITs probably traded a 1% premium to the underlying net asset value. But within any average, you see outliers. Some trading at 20% discounts, some trading at 20% premiums or more. And folks like us, jobs is try to differentiate and discern which ones are which.
One area you're watching is rental apartments. There are some REITs that track that, and there in some areas a deep shortage of rental accommodation.
There's also very powerful demographic and secular factors. You have, young millennials that are getting married later, they're having children later. You have aging baby boomers that are transitioning from home ownership to rental apartments. You have a secular change with millennials preferring to walk to work, urban lifestyle, going to restaurants. Many don't have cars, some don't have driver's licenses. And these are all powerful demand forces. Immigration in this country, we went from 250,000, arguably closer to 400,000 immigrants this year. Student housing. So this is a place we like. It's a defensive investment. Financing's always available because of guarantees on the mortgage, and it's a sleep at night place. And if you do a job like us do in terms of supply and demand, you can get above average rent growth because you can get those markets where there's tight supply and demand, very limited new supply, dealing with this increasing demand.
You mentioned seniors moving to rental apartments, although I believe there's been a trend in recent years that the seniors have seemed reluctant to move out of the big home, but some, of course, will move.
They're reluctant to change to an institutionalized environment. But moving from the home and taking their capital and getting into a nice condo is something that is happening.
No more shoveling, no more fixing the darn roof.
Exactly.
I can only dream. Yeah.
Indeed.
And what about? Just to stick with residential for a second. Is there a danger that millions, tens of millions of baby boomers will start dumping their houses on the market all at once?
I think it depends where you are. I mean, our job is to focus on supply and demand by property type and geographic region. And in many areas, while you've seen a lot of cranes in the sky building condos, there's a shortage of single-family residential lots. And so we're not particularly concerned about the traditional single-family resident. There's still a shortage of those lots. We'll talk about it in this area. You've seen what's prices. So condos, you got to watch. We like rental apartments. Differentiated from condos.
We're going to be back with Jeff Olin, president and CEO at Vision Capital. He's answering your questions on real estate stocks and REITs. Give him a call, 1-855-326-6266. We have an email from Scott. True North Commercial REIT is the question. TNT.UN. What do you think?
This is one we'd avoid. Firstly, it's in the office sector, which is a tough business. The capital expenditures required. Not so much people focus on the boilers and the roof. The issue in an office is every time a tenant leaves, you've got to re-tenant it, give them free rent, pay for the fix up their space for tenant improvements. You combine that with secondary markets. This REIT has an external management structure, which is something we tend to shy away from. There's a lack of alignment there. They have a lot of high leverage. This is something we'd avoid.
How do REITs, well, I don't want to say get away with it, but why do people still have external management structures? Because they've long been unpopular with investors.
They've been unpopular. I thought we left this behind in Canada in the 1990s. Americans tend to not tolerate this. It's really a function of why folks like Vision exist. Inefficiencies in our markets driven by an oligopoly of 5 banks. It's not that competitive a marketplace. And as long as the Canadian banks will support these structures and investors will buy them because the banks sell yield to your viewers because yield sells, they put a high yield on them, they sell them to retail investors, and as long as they can sell them, Bay Street will package them up and deliver them.
Because it's almost an axiom that I want to see management with skin in the game.
You do?
Yeah.
Well, here's the opposite.
Yeah. Peter has sent us an email, wants to know about Artis REIT. Can I get your opinion, please?
Yeah, Artis REIT is, there's good management at Artis, but they've been in sort of almost in a perpetual evolution of their strategy. There's been some activist investors there. They've been trying to respond to them. We think maybe they're paying too much attention to them. They've been trying to sell portions of the REIT assets. They've sold assets. They've been trying to sell the REIT. This is a hold. It's not something compelling. If they do sell it, there's going to be a big tax bill. I don't think investors have really focused on that portion of it right now. Had a decent run. It's come off. It's better value. It's a hold.
Oh, okay. Henry in Hamilton, Ontario. Go ahead. You're on the air.
Gentlemen, Granite REIT. First, is it a growth REIT, in your opinion? And second, at this point in the interest and market rate cycles, is this a good choice? Thank you.
Thank you.
We like Granite REIT. We like it a lot, in fact. They have outstanding management. We got an update from the CEO yesterday, in fact. They're in the right asset class, industrial real estate globally. It trades at roughly a 6% cap rate where transactions are taking place. Blackstone's buying portfolios at 4.2% cap rates. They do have a significant concentration exposure to Magnet, but they've done an incredible job of lowering that almost to 30% on an absolute basis over the last 3 years. We like the positioning of industrial real estate. We have a big weight to industrial real estate. You have powerful secular changes from e-commerce activity. All the pain in retail is benefiting industrial warehouse space. Unless you think e-commerce as a percentage of total retail sales is going to stop doing that and turn around and do that, we think that's early. It's got a great balance sheet. It's the largest industrial REIT in Canada. It's going to grow. They're going to do development. They have the skills and expertise to do it. This is a core holding if you like, if you're looking for REITs and you want to be in industrial real estate, and you get some global exposure along the way.
Now, you mentioned that you used the term cap rate, very common in REIT investing. You said Granite had a cap rate a bit more than 6%. What does that mean?
So that's the unlevered return on the investment. So if you take the profitability, the net operating income, and you divide it by a cap rate, you get value. So the lower the cap rate, the higher the value. So if you're buying something inherently that has a 6% return, 6% is much higher than 4.2%, where Blackstone is buying portfolios at. And so you have the sector trading at much higher valuations than it's an inverse of a cash flow, effectively. Lower cash flow multiples is another way to look at it, or low priced earnings multiple, which most of your viewers would be familiar with.
Okay, so the higher, the more expensive, in other words.
The higher the cap rate, the higher the return, and the cheaper the stock.
Oh, so you want to see a high cap rate then?
You want to see a high cap rate if you want to buy low.
Okay. Okay, so you're saying that it has a cap rate a bit north of 6, whereas Blackstone is right now investing.
Yeah, you're getting an unlevered return of 6% versus Blackstone's getting an unlevered return of 4.2%. You add some leverage and some growth, it's a big difference.
Okay. Henry, thanks for that question. Stephen in Calgary, go ahead, please.
Randy, first-rate show.
Thank you.
Jeff, I wanted to get your thoughts on Killam Apartment REIT's management, assets, and their operating performance year-to-date at about $20 a share. Do you think this is good value? Thank you.
Killam.
We think Killam is fairly valued. Management's done an outstanding job. Full disclosure, co-founder Vision, myself, Frank Mayer, helped create Killam in 2002, so we know the situation very well. They've diversified somewhat outside of Atlantic Canada, but they still have a significant concentration in Atlantic Canada. They're great managers. There's a portfolio transaction in the marketplace right now in Halifax. There's rumors that is going to, you come back to cap rates, there's rumors that's going to trade at a 4.2 to 4.5% cap rate. That's low, which means high value. If that occurs, Killam is undervalued. We do own it. We like it. It's fairly valued.
Sorry, what did you say? There's some kind of an IPO coming?
No,
or,
portfolio sale, apartment portfolio sale. Transaction. Somebody's trying to sell a portfolio of apartments.
Right.
And Killam's in apartments in Atlantic Canada.
Sure, but the thought is it's going to be sold at a much higher valuation than
Correct.
trades
And
right
if
now.
you use that valuation to mark to market Killam's portfolio, Killam's undervalued today.
Actually, one question. I've wondered about this on the channel before. In the old days, I understand life insurance companies would own apartment blocks.
Yes.
But they stopped doing that when the industry, partly because condos, developers fell in love with condos. Is there any way the life companies would get back into owning apartment blocks? Because they're such, you would think to be very suitable assets, a long life, etc.
I think they are. They were out of them. Frankly, a lot of the institutions and pension funds were out of apartments. Frankly, I think it was political reasons. Because you have a tenant that complains that the heater's not working, and they see that Ontario Teachers Pension Plan is their landlord. The political ramifications were something they want to avoid. But they've now recognized this is a mature, great asset class, and they're all coming back in. Most of them are coming back in by sponsoring new developments, so they have newer, higher quality portfolios.
That sounds good, because we need more rental accommodation.
We need them desperately.
And they've got a lot of money.
And they do. And they have a longer term horizon to address the lease up that takes place and some of the vagaries in the short term.
Jeff Olin is our guest. He's CEO of Vision Capital. He's answering your questions on real estate stocks and REITs. Give us a call, 1-855-326-6266. Jennifer in Markham, Ontario. Go ahead, please.
For taking my call
Pleasure.
today. It's regarding Brookfield Property Park. What needs to happen for this stock to start, moving, gaining? And where do you see this stock in a year from now? And what's the target price? And it seems to be stuck for a while. I'll hang up and listen to your answer.
Brookfield Property Partners, that's a good word. It's been stuck. It has been stuck, and frankly, we think it will continue to be stuck. There's no question Brookfield Property Partners is, one, very high quality, two, cheap in terms of underlying value of the real estate. But we think it continues to be cheap. It suffers from an external management structure with Brookfield Asset Management, which is a large owner but enjoys a lot of fee structures. It's not a corporation. The governance is not great. Has a nice dividend. Their the property types they are in is office in London, which is pretty good. New York City, which is somewhat challenged. A big retail presence. They did buy GGP, which was an S&P 500 corporation in shopping malls. Some have questioned the timing of that. They bought it pretty well. So they're in some asset types. There are a lot of asset types. But we think experience has shown, whether it was the acquisition of GGP, whether it was buying Brookfield Office, whether it was buying Brookfield Residential, each one of those situations, there was a deep discount to value in terms of the stock price versus the underlying value of the real estate. In each case, people like us identified that. In each case, Brookfield did not pay full value when they privatize it. So Brookfield Asset Management controls it. We think that discount will persist. We think you'd be better off to buy the parent company, Brookfield Asset Management, which has some of the similar attributes, but here you're going to collect fees as opposed to pay fees to an external manager. And so we think it's a bit of a value trap.
So your feeling is that when they privatized previous affiliates, they paid a relatively low price?
Forget my opinion. The fact is, last year, around this time, Brookfield Property Partners bought GGP. Okay. Brookfield Property Partners reports in Canada with IFRS accounting, which requires them to mark to market the current market value. They held the shares of GGP, because they owned 34% of it before they bought it, on their books at roughly $29.50 per share. They bid $22.50. Forget what I think. That's what they thought, and then they increased their bid ultimately to win, but like to 23 and change. And so this has been the track record. You benefited if you own Brookfield Asset Management. You didn't benefit if you own the underlying entity. that they privatized. Certainly not to the degree that the underlying value. These are the smartest guys in the room, but you got to be aligned with them, and you can be aligned through Brookfield Asset Management.
So own the organ grinder, not the monkey.
There you go.
The argument there. Okay. Good stuff. Peter in Vancouver, go ahead, please.
Taking my call.
Pleasure.
Jeffrey, you last appeared on July the 31st, and two of your top picks have done very well. So you do have vision. May I ask your expert opinion on H&R REIT? Thank you very much.
Well, okay, the H&R REIT. Yeah, I'm sorry. Yeah.
Thank you, Peter. It's nice to hear from you. Peter, the H&R REIT is, as you may know, is one of the granddaddies in the space, if you will. It's a large REIT, $6 billion market cap. It has a 6.4% dividend yield, which is probably safe. But it's not really something that's in favor, certainly never in favor of the U.S. because it's diversified. American institutions, they want their office here, the retail there, the industrial here. And H&R is a mixed bag of retail, of office, a little bit of industrial, and some residential. And they have weakness in the U.S. They bought Primaris here a number of years ago, which is sort of B, A- malls. We know that retail is challenged, so that's hurting them for sure. It's a hold. You can sleep at night owning it, but it's not a favorite name for us.
Okay. Andre in Chilliwack, BC. Go ahead, please.
Morning, Andrew. How are you?
Very good, and thanks for calling.
Good. I listened to the comments already on Granite, the industrial REIT. I'm just inquiring on WPT industrial REIT. Is it the same as Granite? Would you be a buyer of this? Or if you had a choice, would you buy Granite or would you buy WPT? Thank you very much.
Thank you.
Great question, insightful question. Yes, WPT is in the industrial space, which we like a lot. However, it's got a concentration. Firstly, it's U.S. assets listed only in Canada. Why, you say? Because Canadians supported external management structures, which WPT was initially, but they internalized. So now they are more aligned, for sure. And as part of that internalization, two large Canadian institutions entered into a partnership arrangement to do development in the United States. So there's still a little bit of lack of alignment. They would suggest, credibly so, that it was too big of opportunities for them to do. It's a small REIT. They have focus in the Midwest, which has not benefited to the same degree as the coastal markets. In many of those markets, there's not constraints on new development. There's lots of land, whereas in Los Angeles, New York, New Jersey, there's constraints on new development. That's changing a little bit. The cap rates, again, the unlevered return, have been higher in those markets, so it justifies a lower valuation compared to other REITs. It's probably the most illiquid in the universe. We think it's a hold, but we would prefer Granite for the reasons we talked about earlier, and we prefer other names, WPT. It's had a good ride. At this price, it's reasonably valued.
And is it mostly warehouses for e-commerce?
Industrial warehouses, some of which a lot of is focused on e-commerce and traditional industrial warehouse uses.
Stephen in Vancouver, go ahead, please.
Thank you for taking my call.
Pleasure.
And sir, I would like to ask you if which of the two that I should be investing in. One of them is Canadian apartment REITs as opposed to inter-rent REIT. If I may have your opinion, please, and may I have the consensus on the winner? Thank you so much.
Okay, thank you. You know, I'm challenged. It's like asking me which ones of my children I love more. The honest truth is they're both great investments. They have similar attributes, which is probably the prescient nature of your question. And they both have exposure to Ontario rental apartments, which have a shortage, as our host have highlighted for us. Inter-rent historically in recent years, has been a real darling, and we've loved it. We've owned it for a long time, as we have for CapREIT, because they're in value add. Great management team that buys undermanaged properties that have physical or operational challenges. They put in capital, they fix them up, they get a better tenant base, they get higher rents. It's a great story in that regard. CapREIT is the largest residential REIT in the space, outstanding management. They benefit from having about 11,000 manufactured housing community manufactured housing communities, which is a great asset class. People don't talk about it. They have the largest landlord in the Netherlands, which I spent some time on. It's a great marketplace. They've got 10,000 new apartments they can develop on land they hold now. It's hard to choose between both of those. Keep both of them.
Just one thing, and we are going to be talking more about that, just one thing on InterRent that I'm curious about. The yield seems so low, only 1.9%. People are willing to pay for growth in this case?
You know, it's a danger for any investor in any sector to evaluate any business based on what the cash flow somebody is going to pay you as a dividend today, as opposed to how much cash flow they're going to earn tomorrow. This was the big problem in the income trust sector. So we like yield, but yield is part of a total return. And those that focus on yield as a key, true north question earlier, it seems every year there's 1 month in the Canadian REIT sector where the stock prices goes down that destroys your yield for the year. So don't look at yield unless you're going to look at it as part of a total return. And most of the REITs that have been highly rewarded in last year have had low yields because they have higher growth, they have less fee leakage to investment bankers in terms of fees, they have more flexibility to grow without relying on capital markets. So yield is important, but it's just one factor, and it's by far not the most important one.
Okay, well, stay tuned. Past picks from Jeff Olin are coming up, and he did well on a cold storage REIT. We'll have that after the break.
Ideally,
Jeff was on our show July 31st, so it's not very long ago. Americold Realty Trust, COLD, in New York, a total return of 13%.
Yeah, I mean, we like this. I think we're going to talk about it in a bit as well. This is one of the few real estate entities that you could say has a moat for those your investors that, you know, it's not too often you find a real estate company that strategically has a moat, a very defensive positioning, competitive, hard to compete against it. They're in temperature-controlled warehouses. There are very few players in this business. It's operationally intensive. This is the largest in the world in the public realm and one of the largest in the world, period. Outstanding management, relatively new entrant to public markets, New York Stock Exchange listed. Management's done a great job. We think this will be a core holding for us for a long time. We think it's very early stages, and you know, it continues to be a top pick of ours.
Okay, Canadian apartment REIT, we touched on it before the break. Total return of 15%. Would you stick with this one?
Absolutely, absolutely. It's all the factors we talked about, and it's the right space, the right time. Shortage of rental apartments in this country generally, particularly in the markets in which CapREIT is in. Strong management, some bells and whistles that are outstanding with the manufactured housing communities and the apartments in the Netherlands and Ireland, which are, you know, Netherlands is the third most densely populated country in the world, and there's a big housing shortage, and CapREIT's benefiting that through another public entity called European Residential REIT, which they own 70-some-odd% of. So you can buy that on its own, or you can get it through CapREIT to a smaller degree. So we like CapREIT a lot.
The third most densely populated. That's interesting. Yeah.
Yes, you wouldn't have thought that, huh?
The Dutch have had to make their own land, of course. It's amazing. Yeah. I remember driving up around the Zuiderzee years ago. Just an incredible country. Yeah.
Fascinating.
So resourceful. Your last one, has this anything to do with the eccentric aviation tycoon Howard Hughes?
Very little, but a little bit.
Okay.
In that certainly it's the same guy that is the brand, the Howard Hughes Corporation, HHC, on the New York Stock Exchange. So a large entity. The answer to your question that they still have the original Howard Hughes lands in Las Vegas, in a community called Summerlin. What happened here is there was an announcement at the end of June. Bill Ackman, who's a large shareholder and chairman, At the end of June, there was an announcement at CNBC that he had announced a strategic review because the stock's worth around $170 a share at least. It was trading around 105 at that time that they were undertaking a strategic review. The stock jumped on that news to $135, $140 a share because a lot of people came in as short-term shareholders trying to play on this opportunity. They announced in September they completed the strategic review. They did not undertake a sale, but they did a significant restructuring that's going to save $50 million a year. So you go back to cap rates, $50 million divided by a 5% cap rate, that's $1 billion in value they created. But those that jumped in to be short-term, opportunistic were disappointed. They dumped the stock. There's great value there long-term, but those who were looking for a quick buck were disappointed, dumped the stock, and that's what's happened in Howard Hughes. Still great value, 6 assets, determined 80%, one of the best quality real estate assets in the planet. No dividend.
No dividends. There
no
you
dividend.
Yeah.
Don't ever need to raise money, so they're off the radar screen from a lot of the index funds in the United States. They do development, which is something that some investors don't like. They're creating tremendous value at the Howard Hughes Corporation. And for those that have a long-term horizon, we think this continues to be an interesting opportunity.
We're going to be back with Jeff Olin, CEO of Vision Capital. He's answering your questions on real estate stocks and REITs. Give him a call, 1-855-326-6266. In Calgary, go ahead, you're on the air.
Hi, Andy.
Hi.
Thank you for taking my call. My question is WH. Is it a good time to get into it? And do you see more upside to the stock? And is it dividend safe? Thank you.
Thank you. Northwest Health.
Yeah, I think the dividend is pretty safe at Northwest. This is a very interesting entity. It operates globally in healthcare, hospitals. They own hospitals. They have a big position in Australia and Brazil and New Zealand and some medical office buildings here in Canada. It's a complicated structure, a variety of intercompany relationships and joint ventures. Very solid management. It's a long-term contract business, which is good for a REIT, and so hence a reasonably safe distribution. There is some exchange rate risk in the fact that they are global. It's a $1.6 billion market cap, is a nice 6.5% dividend yield. It's had a decent run recently, so on a pullback, but it's fair value.
Fair value. Okay. Let's head to Peterborough, Ontario. John, go ahead, please.
Hi, gentlemen. Thanks for taking my call.
Pleasure.
I recently took a small position in Summit Industrial REITs, and I was wondering what your opinion is on that. And if I could I get the street consensus? Thanks very much.
Summit Industrial, sure.
So Summit, we like Summit. Again, very solid management. These guys have been focused on industrial real estate in Canada for decades. They've had a great track record of surfacing value for their investors. They have a big presence in Toronto. Toronto has a 1% vacancy rate, and it's the second largest industrial real estate market in North America. Rents were flat for 10 years in Toronto, between $5 to $5.50 a square foot. In the last 3 years, they're up 80 to 100% because of this phenomena, EV commerce activity, because of the voracious demand from the Amazons and Federal Expresses and changes to supply chain that are occurring. It's relatively easy to build industrial real estate, but it's not so easy to get the land zoned in the right location where these users want to be or need to be. And so we like Summit. They recently did an acquisition in Calgary. Some have questioned their timing there, but we think it's solid management. We own it. It does trade at a premium to net asset value, but that reflects the growth that you're going to see here. And even though it is at a premium to net asset value, it trades at a much lower premium than the U.S. industrial REITs trade at, and it's owned heavily by Americans at this juncture. So we own it. We like it.
Looks like the analysts, they're divided. There's 4 buys, 4 holds. The average target about $13.70 and the stock just under $13 today. Thanks for that question. Peter in Toronto, go ahead, please.
Well, hi. Would you be a buyer of Next REIT investment trust at this point? It's gone up quite a bit in the last little while. Just wondering if you would get into it at this price. Thank you.
Sorry.
Thank you. Next REIT.
I think you might be referring to Nexus.
Oh, Nexus. I'm sorry.
Nexus
Yeah,
REIT. I heard Nexus as well.
Both he and I got that wrong. Sorry, Nexus REIT. Yeah,
Nexus REIT. So it's a hold. It's a tiny REIT. It has a big yield, which is too high. So they need to cut their dividend. Payout ratio's close, but they did a big portfolio acquisition of retail in Quebec, the wrong acquisition at the wrong time. This is not. It's a hold. Wouldn't be a top pick for us.
Okay, sorry. They did a big acquisition
of retail malls, community shopping centers in Quebec, in secondary markets. They called a lot of Montreal, but these are, 2 hours outside of Montreal. This is not something that they've got a sports complex they're looking to develop in BC. They're having some issues in terms of getting that done. It's a bit of a mishmash, $200 million market cap. Don't be seduced by the yield.
Yuri in Keene, Ontario. Go ahead, please.
Hi, guys. Thanks for taking my call. I'm a huge fan of Brookfield people, and now I'm investing in RA, the Brookfield for Real Assets Income Fund, with a dividend of 10.9%. I have been investing, and I want your thoughts. What do you think of this stock? Thank you.
Thank you. So you touched on Brookfield already. It's your preference among the web of companies, the top company.
Brookfield Asset Management is where you'd be, doesn't have that big yield that you mentioned, but this is one of the finest quality companies on the planet. And so why not invest with the guys that are collecting fees from all these subsidiaries and make their capital allocation decisions, and are aligned as investors at the parent company. They're not aligned directly at any of the subsidiaries level. So our preference was to see you hold Brookfield Asset Management.
Okay. We have Nick standing by in Toronto. Go ahead, Nick.
Hey, guys. Thanks for taking my call. I'm curious to hear your thoughts and opinions on Allied Properties and whether or not you see continued upside in the company. Thanks.
Thanks.
Yeah, Allied is well positioned in that a significant portion of their portfolio is Toronto office and niche Toronto office, cool Toronto office, where the millennials want to be, the tech companies want to be. The management has done a good job. It does trade at a good stock price because of the good job this management has done. So it's not cheap. Hence, it's not a core holding for us today, but if you own it, it's certainly a hold. They've got a big development on I think the former Globe and Mail site over there on the west end of...
Down on Front Street.
Down on Front Street, which they're developing, and I think they've got Shopify moving in there, and they're going to build some apartments, and RioCan's doing a joint venture there. Toronto office market looks really good right now. There is a bunch of new buildings coming on stream to deal with low vacancy rates, amongst the lowest vacancy rates in North America, if not the world. We think that might change 2022, which is a long way off. So Allied is, has a nice yield, good management, nothing wrong with owning Allied. But at these levels, we're looking to buy at a discount to net asset value. And Allied trades at a premium. Hence, they just did an equity issuance, which is quite accretive because they sold stock at a premium to the underlying value of the real estate.
We are going to take a break. We're talking real estate, stocks and REITs with Jeff Olin of Vision Capital. 1-855-326-6266. Rob in Fernie, BC, which is a place I will never ski because I gather it's very difficult. The Sun-Mail. What do you think of Slate REIT? Is the dividend safe?
Firstly, Fernie, you should definitely go there. It's fantastic.
Well, I've heard every run is very difficult, though.
Nah, you'll be fine.
I don't know if I will be anyway at my age.
Anyway, visit your viewers. Slate Retail REIT would be a hold, perhaps a sell. It's U.S. grocery store anchored, primarily small community strip shopping centers. It has a high dividend yield. It has an external management contract, which is something we've talked about earlier on this show, which is something you need to avoid, generally speaking, because there's lack of alignment. These entities benefit typically by growing for growth's sakes, not necessarily by growing their cash flow and their stock price. And the stock price has really never got out of its own way since its IPO. It's small. There's going to be a big payment to internalize that at some juncture, and that's going to destroy value here. We just don't like the external management arrangement here.
Okay, so that's, yeah, because often when they so-called internalize the management, there's a big payout, isn't there?
Exactly.
Kind of an overhang there. Okay, we've got John in Unionville, Ontario. He's a great question. Go ahead, John.
Good afternoon, guys. My question is, if you're dealing with somebody who is in semi-retirement or about to go into retirement, where the monthly dividend is something that is important, I understand, I heard your synopsis, that is one of many factors one should take into consideration. But if you are looking for income and you could recommend one stock, which one would it be? One stock or one REIT, which one would it be?
Yeah, I mean, we talked about CapREIT earlier. It's a sleep-at-night stock. That is a relatively low yield, as highlighted. If you're looking for something with a little higher yield that is very defensive to provide the attributes that you're seeking.
I think we have the Slate chart up there inadvertently. Carry on.
Sienna, SIA would be a name that I would look at. This is $1.2 billion market cap. It has a nice 5.1% dividend yield. The timing is good to buy this, in our view. They had a bit of a soft quarter. We think it's transitory. They own 7,000 long-term care, skilled nursing residences, 3,200 retirement homes. The demographic factors are supportive of this. They have a heavy presence in Ontario. There's a shortage of 35,000 nursing home beds in this province. The government is struggling to find a formula that will incent industry to build more, so they're very well positioned. They're very strong management, very solid governance, and so it's a stable business. Sleep at night, get your 5% yield, and we think this is undervalued. It's probably worth $22, $23 a share. So you're going to get some capital gains on top of your dividend. So that's a great name for your objectives.
Okay, thanks for that great question, John. Ram in Calgary, fire ahead, please.
Hi. My question is about U.S. warehouse industrial REITs. There is always very acute shortage of warehouse space in the States. But on these stocks, they always sell at the highest possible price of their price range. And thirdly, like a couple of companies, Prologis or Equinix, these kind of companies, would you have any company in mind which can give decent return? Thank you very much, sir.
Thank you.
You're welcome. Well, you certainly hit on a hot topic. We touched a little bit about it, but let me put a little bit more meat on the bones for you. We tour a lot of warehouses, not very exciting, but we do it, industrial warehouses. If you tour a warehouse that serves as a store, you find skids and pallets. If you tour a warehouse that serves as e-commerce, you find parcels and packages. The demand from the Amazons, FedEx, as we've talked about, being voracious. One of the buzzwords that's evolved is reverse logistics. If you buy something in a store, there's an 8% likelihood you're going to return that item to a store. If you buy something online, there's a 30% chance you're going to return that item to the warehouse.
30%?
30%.
Of online purchases are returned?
Yes, sir.
It can't be that high. Come on.
Some of it's 60%. They have subscription models, and they intend they'll send you 3 items, and they think you're going to keep 1 and send back 2.
That's mind-blowing.
Well, that's why there is, your caller's question is right on point. This sector has seen very strong growth. We talked about what's happened in Toronto rents, $5 to $5.50, now north of $10 in Vaughan, Ontario for industrial real estate. We see the demand side is very solid. You got to watch supply. Valuations are getting rich. We like the space. We trade around the U.S. It's hard to give you one name in the U.S. because they change a lot. One name we'll talk about we own today is First Industrial in the United States. That is a good name. It has underperformed relative to the others. We think it has some legs to it. So First Industrial would be one that you can look at in the U.S. But we think some of the Canadian names are better. Dream Industrial is a big holding of ours. They have exposure to the United States. So we think you get a better valuation. You get exposure in the U.S. They got a senior guy. Granite has exposure. We talked about that. They just hired a senior executive from Prologis. Prologis is the largest industrial logistics company in the world, over a $40 billion market cap. We think Granite REIT gives you some exposure to that U.S. and global marketplace at a better valuation and a great balance sheet.
That's amazing. I mean, I do know that millions of packages get returned. I think they're looking at 1 million packages a day in America will be returned around the holiday season.
Absolutely. Logistics opportunity.
That's incredible. Yeah, the amount of warehouse infrastructure needed. Bill in Burlington, Ontario, let's squeeze you in. Go ahead, please.
Could Mr. Olin comment on Plaza REIT? I understand it's mainly strip malls in Eastern Canada.
Okay.
You've described it well. Outstanding management here. Maybe amongst the best, if not the best in the business. Michael Zakuta and his team. They're large shareholders. $400 million market cap, has a nice 6% yield, which we think is safe. Typically it's not something we've been short retail. We're a long short fund at Vision for years, but we've never been short Plaza REIT because it's such well managed. They do such a good job, and it was recognized recently because Morguard Corporation, Ray Sahi, recently announced the end of September that he's invested a 15% stake in Plaza Corp, citing for investment purposes. We don't think a transaction for Plaza Corp is imminent, but you can't rule out a more substantive investment by Morguard in this. It's a great managed REIT, and you can hold this REIT.
Okay, we've got top picks from Jeff Olin coming up after this on Market Call. Americold Realty Trust, you're sticking with this cold storage giant.
We're sticking with it. I mean, it's in that industrial warehouse space generally, which we've talked a fair bit about. It's got that moat from being in a temperature-controlled space, mission-critical requirements, shift to more fresh, natural food, which we're seeing consumers and commuters tend towards. It's got twice the growth of the industrial warehouse names in the U.S. we talked about, and trades at the same multiple. That's a short-term opportunity. The long-term opportunity is it trades at a higher cap rate, a lower valuation related to industrial, and we think there'll be a secular change in this over the longer term as well. So this is a short-term and a long-term investment opportunity.
Tricon Capital, it's been a player in residential real estate south of the border.
This is definitely a top pick for us. It's a large holding. They're focused on rental residential in the United States. Two major themes, and in Toronto, but two major themes. Single-family residential, so renting a single-family house. This is a burgeoning asset class. They're in the mid-market space, which we think is the right space to be in because at the higher end, people will move out to buy houses. You can rent a house for less than renting an apartment and have a yard. We like that, and they're also in the high-end rental apartment space in the Sun Belt. Outstanding management. Gary Berman with some Francis. They're highly aligned. Most of the U.S. peers trade at a 20% premium, 10 to 20% premium. This is trading at a 20% discount.
This is Tricon.
Tricon,
Yeah.
trading at a 20% discount to net asset value. We think this does very well over the next year.
And this, there's some similarities here. BSR, they're in multifamily buildings in the Sunbelt states in the U.S.
We also like BSR REIT, also a large holding, also in rental apartments, not in single-family residential, but in apartments in the Sunbelt, affordable apartments. So they're very defensive in terms of recession because of their rent. They're not exposed to new supply because their rents are lower than the rents required for new development. Management owns 50% of it. Highly aligned, the opposite of external management with BSR. Great management, been recycling capital. 50% of the net operating income is from Texas. We think that's going to go to 70% with their transition to recycling capital. And we think in the short term, probably worth $13.50. Again, if you have a re-rating of this stock as to transition from secondary, tertiary markets to primary markets, you're going to see that cap rate, which you discount the cash flow, go down, which means longer term, much higher returns than the $13.50 that we see in the short term.
Jeff, I think we've learned a lot about real estate today. Thanks very much indeed.
Thanks for having me.
Jeff Olin of Vision Capital has been our guest on Market Call. Thank you very much for watching. The Encore presentation airs Monday through Friday, 1 a.m. Eastern, 10 p.m. Pacific. And we are live Monday through Friday at 6 p.m. Eastern with Market Call tonight. Thanks again for watching. Have a great day in the markets.